Hello, friends. Welcome to yet another episode from Weekend Investing. We do these data-backed analysis of markets and try to derive insights from there. Today is another one of them. If we look at what market has delivered in terms of returns over the last, let's say, 30 plus years, so we've had about 11 to 12% CAGR, sometimes closer to 12, sometimes closer to 11. But that's where the range has been for long-term investing in the Indian index market. Now, most of the folks actually don't even know what kind of returns they're generating. Maybe you are not in that bunch because you may be a more evolved investor, but I can tell you with experience of talking to many investors is that several folks who do direct investing, because if they're doing mutual funds or something, the app will tell them, this is your XIRR, this is what the returns you've generated, so on and so forth. But for most others, or if they are, dabbling in direct stocks, trading, so on and so forth, they're bringing in money at some time, they're taking out money at some other time. They have actually no way of telling you or even knowing themselves what is their returns for the efforts that they are putting in the market. So knowing your performance or your strategy's performance itself is a big deal. Uh, uh, when you see the probability or the statistics in the market amongst the market men. So knowing that if your strategy is beating the benchmark or not is for the first and foremost statistic that you should be knowing. The Of course, the primary objective remains that we want to perform better than the benchmark over the long term. Because if we are putting in some effort into a strategy, into buying and selling, spending some cost on it, we definitely want an outcome which beats the benchmark. Otherwise, low cost index funds probably are the best bet to just get benchmark returns, and everybody wants an additional alpha on top of that. So we want to understand then, what kind of outcomes we can generate even with the slightest alpha delivered or achieved above the benchmark. So if the benchmark is 12% and if we get 13%, what does that do to your portfolio over a long period of time? That's the aim of this current study. So can a mere 1% extra returns have any impact on your outcome? So let's take a case study. Two friends, Ravi and Arjun, they are both investing. Ravi is investing 25,000 monthly SIP with a XIRR of 12% for 30 years. And the final corpus that he achieves over a period of 30 years is 7.7 crores. So these are just case studies for the benefit of trying to evaluate what slight changes in your returns can do to your final outcome. Arjun, on the other hand, is also doing a 25,000 monthly SIP, but is able to generate 2% additional XIRR by whatever means. Maybe he's doing some strategy, maybe his stock selection is better, or he's brought in more money in lump sum at lows of the markets, whatever may be the cause of it. But he's able to generate 2% additional XRR. So what is that final corpus? How much more from 7.7 crores do you think Arjun has achieved over 30 years? So, is it 50 lakhs? Let's play Kaun Banega Crorepati. 50 lakhs, 1 crore, 2 crores, or 3 crores. In your mind, you can freeze your answer and I'll tell you the answer. So the answer is a whopping 3.8 crores more. So one friend made 7.7, the other guy made 3.8 more than him just by the returns being 2% additional. So, the slow moving compounding calculation that happens does not make it obvious while that process is on, because 30 years, of course, is a very long time. And minor changes in your strategy itself may be able to help you achieve more returns. So every percentage increase in returns can yield substantial difference in the outcome of the corpus. So let's visualize the impact of 1% increase in returns. So let's say 25,000 monthly SIPs, 30 years, total invested sum is 90 lakhs. And these are oversimplified examples. I'm not saying that one should be doing this. because your income also grows and you will step up your SIPs and all kinds of those kind of things will happen. So these are just very, very oversimplified case studies. So what is that final corpus and how many times is it the invested sum when we move from XIRR of 12% to XIRR of, let's say, 19%? So when we have XIRR of 12% and we are investing 90 lakhs over 30 years, our final corpus, as in that example, was 7.7 crores, about 9 times the original investment. And as we increase XIRR, if we are able to get to 14%, our 90 lakhs invested becomes 11.5 crores, 13 times of investment. Uh, as we go down further, 16%, it becomes 17 crores at 19 times investments, and maybe at 19%, it becomes 31 crores at 35 times investment. So you can see that this is a sort of a exponentially rising outcome basis the XRR going up. Uh, now let's also see if the invested sum is 90 lakhs and XRR goes from 12% to 19%, then what is the percentage increase from the base of 12% XRR for each rise or each jump? So here you can see that when you go from 12% to 13%, your corpus goes from 7.7 to 9.4 crores, which is an increase of about 22%. And when you go from 13 to 14, again, the corpus will grow at a 22% additional from the previous XRR and 49% from the base of 12%. And if you go down much further, you'll find that we will achieve a situation where if you're able to, let's say, get 18%, which is obviously not easy, but if one is able to do that, you will be generating 237% more than what you would have got at 12% XLR. So that is the power of having additional returns. And it could also mean that in few years when the bull market was happening, you got substantial returns. And in the few years then that the market was languishing, maybe you were getting market returns. That is also okay because it can't be a uniform alpha over the benchmark. But over a large period of time, if you had 40% of years which were bull market years, you had 30% or 40% years which were flattish years, and 20% which were down years. Even if you have made market returns in those 60% where market was flat or down, but you created significant alpha in the upward years, that will also make a huge difference to your overall calculations. The falling years can also make a huge difference, where if there are very sharp falls in the market, maybe your strategy is to go to cash or go into defensive stocks, and you may fall lesser than the market, thus adding to your additional alpha over that entire period. So outperformance being the primary goal, uh, should be our, the outperformance and alpha over the benchmark should be our first and foremost primary goal. How should we achieve that? And if we are not achieving that, then our entire premise of putting in a lot of effort, time, costs, that goes for a toss. Small outperformance can have significant impact over the long term. We have seen that. So every small way in which either you can cut costs or create additional revenues can compound a lot over a longer period of time. And that is obviously due to the magic of compounding, which you all very well know. But on a day-to-day basis, we are not able to see that happen in our portfolio. So we don't possibly give so much importance to it. But as and when you will see it over a very long period of time, even very small changes or small outperformances will really go a long way in standing your portfolio out versus a regular benchmark linked portfolio. As I mentioned, the downtrend part is also very, very significant. Uh, Many a times what may happen is that the market goes up and you generate market returns, the market stays flat after that, you generate market returns. But when the market falls, maybe that is the time where your strategy is able to outperform in a big way. If market falls by 50% and you fall only 25%, you are now at a higher base for the next up move. The market starts from minus 50, doubles to come back to zero. You are at, let's say, at minus 25, and when you double from there, you are at 50% plus. So that is the whole power. So 100, market goes from 100 to 50 to 100, you go from 100 to 25 to 150. That is the 100 to 75 to 150. So that is how the performance of your portfolio in a downtrend can also make a huge alpha generation over the benchmark if the strategy is designed that way. So this is what I have for this video in terms of giving you a flavor of how small gradual alpha over the benchmarks can compound over time for you in different types of market, and how it very important is it to really know what you're doing in the market and how it is generating the returns. Just buying stocks and leaving them and not knowing what is the returns that you're getting, not calculating your XIRR, etc., I think is a disservice to your own portfolio. So be a bit vigilant and know what you're doing. Thanks. Bye.